So thank you very much. Thank you to the conference organizers for including this paper on the program. This is a joint work with Nicola Limoglio, who's with me at Bocconi. So I guess I don't have to spend much time motivating why studying this question on climate and banks is important. Let me just say that what we do in this paper, we focus on physical risk, okay? And we know that this is going to be a relevant risk that the banks and the economy will face going forward. So this will affect households and firms, and banks indirectly through their exposures to households and firms. And we know that this is important also because lately, policymakers, such as the ECB, but also other central banks, have started to assess banks' level of preparedness to assess and manage this climate risk stemming from physical risk. Now, what I want to say, though, is that what we know so far in terms of the evidence on physical risk, it is mostly related to natural disasters. So there's been a lot of literature studying how banks react when there are hurricanes, floods, and other type of natural disasters, which is, of course, very relevant, and we think that these events will become more likely and more severe going in the future. However, studying the responses to these only type of natural disaster is also a bit limited because it is difficult to study this empirically because there is a lot of government intervention after natural disasters, a lot of insurance being paid out after natural disasters. So this kind of makes it a little bit more complicated to assess how banks react to these climate shocks. So we think that now we are going to study in this paper a climate shock that is not, strictly speaking, related to natural disasters. In particular, what we're going to propose and test in the data is a new mechanism. We have a climate shock that affects natural amenities. What are these? These are the desirable characteristics of a location that make it so that people want to live in a particular characteristic because the natural environment around it is nice. And this climate shock will affect the value of these natural amenities. This will then impact house prices, right? Because, of course, if the natural environment around it deteriorates, also the value of real estate will decline. And then this will impact mortgage supply by banks. And so this will, we'll go full circle and see what the impact on banks is. In particular, what we're going to exploit is a recurring natural phenomenon called El Niño. Okay, so El Niño, I'm going to be talking about it later. For now, you should know that this is just an unpredictable atmospheric phenomenon that happens irregularly. It affects weather around the globe. And interestingly for us, it affects the US differentially in the cross-section. So some areas of the US experience higher than average temperatures and others experience lower than average temperatures. So this is going to be our shock. Okay? Now, admittedly, by doing so, El Niño allows us to look only at short-term fluctuations in weather, not these long-term fluctuations in weather which we typically think are associated with climate change. So in a sense, you could think about this paper as a paper on climate shocks rather than on climate change and banks. Okay? But still, we think that this is important because these tail events are becoming more and more important. So the mechanism, which is related to these natural amenities. So this is an empirical paper. And so our theory is just going to be some nice graphs. Well, nice. So we'll see. Hopefully, it's going to be nice. So we have a bank. Take just a bank with a balance sheet. It's quite a complex balance sheet, lots of assets and liabilities. Let's single out the mortgages, which are actually the largest asset class on banks' balance sheet. So this is money given out to households to buy houses. Okay? Now, the value of the house depends not only on the house itself, but also on the natural environment surrounding the house. And so the value of the house, of course, this represents collateral for the loan. And so again, the collateral is on the value of the house, but this also depends on the natural environment around it. So suppose that now there is some climate shock, right? This El Niño, which what it does is that it deteriorates the value of these natural amenities around the house. This will also lower the value of the house itself, the real estate value. This will impact, because this is a source of collateral for loans, this will also impact the ability of banks to provide mortgages. Okay? This will affect the flow, so the new mortgage lending, so the ability of banks to supply more mortgages. And this is what we're going to study, in fact, in the empirical part. This is what we have data for. But you could also think that this affects the stock of existing mortgages, right? So all of the mortgages that were made in a particular location, if this is affected by El Niño through this impact on the natural amenities, this will also impact all of those, and so kind of the secondary market value of these loans is also going to decline. Okay? And then, given that mortgages are the largest asset on banks' balance sheet, this will impact overall banks' balance sheet. Right? So this is kind of our mechanism. Right? It's kind of simple. It's just this El Nino will affect natural amenities, house prices, and overall mortgage supply. So this is the paper in a nutshell. So in particular, then what we're going to do this in several steps. First, we're going to see how climate shocks affect the banking system First, we're going to validate the effect of El Nino on county climates. These are patterns that we know already from NOAA, the US agency that looks at climate stuff. So this, we're going to just check whether this is the case, and it will be confirmed. Then we're going to look at county, again, level, house prices, and mortgages, see how these are impacted. We're going to see this mechanism going through natural amenities. This is actually something that is hard to measure, and we have a couple measures, and we are working on developing others too. We're then going to switch onto a bank level analysis, so see how banks that are more exposed to this shock because they lend more in areas affected by this El Nino, how they react overall at bank level. Of course, one important thing is that looking everything at county or bank level, you cannot really tease out whether it's supply or demand. Our story is a lot on supply, so that these banks are impacted by this shock, and so they lower mortgage supply. We're going to try to do something here, teasing out demand and supply, looking at granular data at banks at county level. You'll see how we do that. So, particularly, what do we find? So first, we're going to validate these patterns on climate. In particular, we're going to show that this El Nino shock is not related to a higher probability of disasters in one of the affected areas we're going to focus on. We're going to find heterogeneous effect on house prices and mortgage lending depending on how the shock hits, because as I hinted, and I'll show you later, this El Nino shock hits the US heterogeneously. Some areas experience higher than average temperatures and others lower than average temperatures. And we find a heterogeneous pattern in prices, in house prices and mortgages too. We're going to see these natural amenities, and the key point there is to show that they worsen when temperatures increase. Right? And so then all of this kicks all of the effect on house prices and mortgages. The bank level analysis will show that these effects at the county level aggregate up at the bank level, depending on banks' exposure to this shock. And to tease out demand and supply, essentially what we're going to find is that bank factors are key in explaining the decline in mortgage lending. And so this is our key evidence that it is a supply side story rather than a demand side story. We also have a part where we do lasso analysis to test which characteristics make bank more resilient to this climate shock. I'm not going to cover this today, but just one thing that we find is that banks that have lower expenses on their physical network of branches, they are less impacted by this shock. So in a sense, which makes sense because this is physical risk coming from a climate shock. Banks that have lower, we can call this operating leverage essentially, we find that they are less impacted by this. I'm not going to do that today. Okay, so big literature here, just for the interest of time, I'm not going to cover this. A lot of people in this room have contributed to this. A lot has focused on banks and transition risk and banks and natural disasters. We are adding the fact that we look at physical risk, and in particular from this El Nino shock, which has been studied, but in other contexts, so looking at the probability of a civil conflict, migration, and overall GDP growth worldwide. So El Nino especially affects developing countries more than the US. Okay? So identification strategy, this is an empirical paper. It's going to be important to see what we do here. So we studied this El Nino. Why do we think that this is ideal? 3 reasons. Okay, so it is exogenously determined with respect to US climate. El Nino is related to what happens in the tropical Pacific Ocean, okay, around Asia. And it arises when temperatures in the Pacific Oceans go up too much. But not only when surface temperatures go up too much, there is also an element that is related to air pressure and wind circulation patterns. And you need both things for an El Nino event to arise. Because of this nature that you need both things, so temperatures going up in the ocean, which is easy to measure, but also this air pressure component which changes the wind pattern, this makes it very unpredictable in the time series. So for example, right now, looks like we are going towards an El Nino, but still it's not clear. It's a 50-50 chance that in a few months we will have an El Nino event. And it's not clear how strong it will be, despite the fact that surface temperatures in the oceans are very high. You also need this ingredient on the wind pattern, and that's harder to predict, as you know, anything related to the atmosphere. And the other nice thing is that not only have this unpredictability in the time series, we also have an heterogeneous impact in the cross-section for the US. Okay? So some counties are going to experience warmer temperatures, other colder, and a nice band of counties in the middle experiences no change, which provides a control group. So again, as I said, this is it's related to this combination of both wind and surface temperature. And essentially what you need is that this increase in ocean temperatures plus this weakening. So typically winds go westward. Okay? But if there are conditions such that these winds that typically go westward weaken or even reverse, then you have this pool of warm water that typically stays towards Asia. It spills east towards the Americas. And when it does, the Pacific Ocean is the largest ocean in the world. And now we have this big mass of warm water that can affect weather worldwide, and especially in Latin America, because now you have this mass of warm water and air going towards the Americas. Okay. Moreover, the impact of El Nino in the US is related to the fact that it alters the jet stream. So these are not this low surface temperature, surface winds hitting the ocean, but these high altitude winds. And jet stream are important because it separates warm and cool air masses in the US. So when you alter that, you can alter the pattern of temperatures and precipitation. Okay. So this is just a map that we see from NOAA. When you have this an El Nino event, you have this jet stream that is altered, and you see that the north of the US experiences, including Canada, of course, experiences warmer than average temperatures. The south experiences colder temperatures, and there is also a non-perfectly overlapping map in terms of precipitations. Okay. We're going to be focusing on temperatures. We study also precipitations, but the empirical evidence suggests that it's temperatures that is mostly driving the result. When you control also for precipitations, there are other things happening. Okay, so we're going to be focusing on temperatures, but of course there is an effect on precipitations too. Now, how to measure El Nino? Again, I said one of the key ingredients here is this surface of the surface temperature of the Pacific Ocean. Of course, there is a continuum of these events. Okay, so there are fluctuations around the mean, and what we're going to focus on are the strongest events. Okay, again, El Nino is not a type of climate phenomenon that affects the U.S. Strongly, so we really want to focus on the strongest El Nino events to try to see some effects. What we choose to pick here, there are these ocean temperatures indexes. We pick just this threshold of when the surface temperatures go up by more than 1 degree, then you're going to have a strong El Nino event. This defines top 5 El Nino events that, those of you who remember this event remember that the 98 was strong, but it was also one in 83 and other years. Okay? So these are the years that we're going to be focusing on. Okay? We're going to look also at the continuous measure, and the effects are going to be similar. In the cross-section, what do we see? Well, we look at some maps from NOAA, and we digitalize those essentially, and we find that the north of the country experience, these are going to be called positive exposure, means higher than average temperatures. Negative exposures means lower than average temperatures. And then this band of counties in the middle that experiences no change. Now, one nice thing, if you look at this, you may be worried that, okay, maybe there's something special about this north and south, and then you're going to be picking up that in those years precisely when El Nino is strong. What we can do also here is that as much as there is an El Nino, there is also the opposite pattern, which is called La Niña. We're actually coming out of a La Niña episode. And in the La Niña episode, the opposite happens. So the temperatures go down too much. Okay? And the map is kind of flipped. Not exactly, but it's almost flipped. So the north experiences colder temperature and the south higher temperatures. And we can see that the effects, in fact, are the opposite when we do the experiment on the La Niña in other years. So, this is really what we think is not just related to the fact that we're picking up a north versus south. If you flip the kind of the shock, okay, negative and positive, and the years, you also see opposite effects. So you're really picking up this climate shock. Okay, so data-wise, we collect, these are all publicly available data. We look at 40 years of data, okay, so quite long for at least what I'm used to do. We look at temperatures from NOAA weather station. We look at these natural disasters, house prices from this FHFA agency, mortgage lending from HMDA, right? And then natural amenities, so I'm going to be talking about this later. This is not clear how to measure this. There are both cross-sectional measures and time-varying measures. All right, so first of all, the first part that we want to see here is how El Niño affects climate. A very simple regression, and we're going to look at, this is a county year level regression, where on the left-hand side, we have either temperatures averages or the probability of a natural disaster. We want to regress this on this exposure measure. So there are two exposure measures, right? So one I here is either P, positive, higher temperatures, or N, negative, lower temperatures. Exposure to El Niño, we multiply this by this El Niño damage, takes value 1 if we are in a top 5 El Niño event. Right? And we can include, of course, only one of the two or both at a time. And then we're going to have county and time fixed effect, and we cluster them at a county level. Okay, so there's some descriptive evidence to confirm the pattern that we know from NOAA about climate. So first of all, this is the effect. Okay? So in the counties that are positively exposed, when El Niño hits, the temperatures go up by 0.6 Celsius degree. Right? And in the negative one, they go down by half a degree. When you combine the two, it looks like the strongest effect compared to the control group, right, is 0.5 degree. So this is a small shock, right? So when a El Niño event happens, there is an increase in temperatures by about half a degree, and this is typically temporary, okay, and this lasts 1-2 years at most. Okay. I forgot to say, right? So these El Niño events happen irregularly. They can happen as close as 2 to 3 years, or even 7 years apart, but they typically last 1 year. That's why we're looking at short-term fluctuations in this. Okay. Now, interestingly, if you look at on the left-hand side, instead of putting temperatures, put the probability of a natural disaster that we get from FEMA, the agency that is in charge of responding to natural disasters. We see that in these positively exposed areas, the probability of a natural disaster actually goes down. Right? So this north of the country that experience higher temperatures experiences also lower probability of disaster. Disasters go up in the south, and this is something that we know. When an El Niño hits, there's a high probability of hurricanes and floods in the south. But in the north, there's a lower probability of disasters. And most of the effects that we're going to find later on the finance part, so on lending and house prices, is going to be on the positively exposed part. Okay, so in fact, if you just redo the same regression, but instead of putting some climate variable on the left-hand side, you put total lending, mortgage lending by HMDA. So this is new mortgage origination at the county level. You see that in the positive exposed counties, there is a decline of about 11%. In the negative exposed one, there is an increase, but when you put them both together, compared to the control group, this band of counties in the middle, it's only the positive exposed counties that experience a decline. Now, why is this happening? You can see also that house prices react to this. And you see the house prices, so in the positive exposed counties, go down by about 1%. Right? Now, why is this the case, right? So because you maybe think, okay, so you're telling me that the north of the country experiences higher temperatures. That may even be good, no? So in general, there are lower temperatures in the north. Like half a degree, a small increase, could even be better. How come the lending and house prices are declining? Well, what we think is happening is that this lowers house prices by deteriorating the value of these natural amenities. Okay? So this local environmental quality of the area of the county. Okay? So the first test that we do here is that we want to see whether the effects of El Niño are stronger in high amenities area. So we can take a measure here from the US Department of Agriculture that combines several measures. This is a cross-sectional measure that tells us how desirable a location is in terms of this natural amenities. Okay? Climate, so this is related also to temperatures, how temperate climate is, humidity, and other things. And this is going to be only a cross-sectional variable. Okay? So we're going to test whether the effects of El Nino are stronger in some of these high amenities area. Okay, this is a map of the US according to this measure. It lines up with your intuition. No, not surprisingly, here in California in the west, there are higher natural amenities. Also here in the south, Midwest, typically lower natural amenities. What we're going to exploit here is that we're going to run the regression, the same as we did before on house prices. And we're going to see interact our El Nino year dummy with this variable and also with the exposure. So first of all, we find that in El Nino years, when there are high natural amenities, these counties experience lower house prices. And in particular, they do so if they are positively exposed. So if there is an increase in temperatures. Okay? So counties that have high natural amenities, where El Nino hits higher temperatures, they also see a larger decline in house prices. And the same is true for mortgage lending. Okay? So there seems to be a channel going through this. Now, this variable is not ideal in the sense that it's only a cross-sectional variable. It doesn't vary over time. Our hypothesis is really that El Nino, when it hits, it deteriorates the very natural amenities. Okay? It makes them lower when temperatures go up. We cannot test this with the previous measure, so we need to come up with some measure of time-varying natural amenities. And it was very hard. What we did find was, and we read a lot of papers on this, they're looking at the salinity of soil and water. And the idea is the following, is that salinity is actually a key input in natural amenities. When you need a stable amount of soil to have vegetations grow, and this provides nutrients to plants and animals. And so when temperatures go up, this increases the evaporation of water from the soil, the water, and this increases the presence of soil in the salt. And to the extreme, you will have a desert, right? Desert have high salinity areas. And so, in order to see this, we look at measures of this water and soil salinity. And this is, when salinity goes up, this is a measure of a deterioration in natural amenities. Okay? And we see that that's the case. In fact, we see that when in the positive exposed counties, so higher temperatures, measures of water and soil salinity increase, especially in these counties. And in the ones where temperatures are lower, instead, there is a decrease in salinity. And we're looking more into this, and it seems to be that we're looking at how, for example, indexes of vegetation that you can measure with some satellite data. So it seems to be the case that when El Nino hits, the greenness and how nice a county is goes down in these positive exposed counties. All right, so after this, so we're looking at this county level pattern on house prices, mortgage lending. We're going to see whether this aggregates at bank level. Very simple regression here. We look at bank level analysis. And the key variable here, and we're going to see some bank balance sheet characteristics. The measure here now becomes, instead of being a county exposure, just is a bank exposure, depending on, so this exposure is this exposure to the El Nino at the county level, depending on how much the bank is lending to that county. We can also do this with deposits or branches. It doesn't matter. It's kind of the patterns are very similar. And we're going to see whether banks that are more exposed to these counties also reduce overall lending or other balance sheet variables. And of course, we're going to put bank and year fixed effects. Okay, so first of all, we find here that also total loans go down. Now we notice one thing. These loans here go down by 1%. Mortgage lending was going down by 11%. So it's a much smaller effect here. And this is, in a sense, you could see this before it was an effect on the flow. So that's new mortgage origination. This is an effect on the stock of existing loans, right? This is what you see on balance sheet. And these are not only mortgages, but also other types of loans. If you split up by types of loans, we see, in fact, if the effects are here on real estate loans or mortgages. There's also an effect on C&I loans. So it seems that there is a transmission. So banks are more hit. They kind of have to reduce also supply of loans to non-financial companies. And there's no reduction in consumer lending. Okay? So this is our evidence. And overall, banks' balance sheet shrinks here for banks that are more exposed. Now, related to supply and demand. As of now, I've only shown you the aggregate effects of El Nino at the county level or at the bank level. This could be due to both supply and demand. Okay? We don't know for now. So a simple test is, well, we can exploit the full so we can exploit some of the dimensionality of Hamda and looking at bank, county, year lending. Okay? And essentially, what we're going to see is whether the bank exposure or the county exposures matter more to explain the decline in lending. So essentially, we're going to run same regressions as we've seen before. Just on the left-hand side, we're going to put log of lending by a bank in a county in a certain year. And we're going to put all of our exposures, both on the bank and county, and both the positive and negative exposure. And we're going to absorb each one with either bank time fixed effect, which will absorb the bank exposure, or the county time fixed effect, which will absorb the county year dimension. Okay? And we're going to kind of do a horse race between the two. Right? So essentially here, here when we put them all together, we see that there is a decline, again, in lending. If you are a positively exposed bank, meaning a bank exposed to this high temperature increase, depending on the county you're lending to, and also for the positively exposed counties. If we absorb these with a county year fixed effect, we see that the bank exposures still matter. If we do the opposite, so we absorb this with bank time fixed effect, we see now that this county year exposures do not matter anymore. Okay? So this is our evidence saying, well, it looks like bank level factors are key, because when you absorb them, this shock doesn't matter, but if you don't, they're still there. And if you want just an even more direct test is seeing how lending evolves in exposed and non-exposed counties. So if you are an exposed bank and you are even lending in non-exposed counties, so we're looking at this band of counties in the middle, they are not directly hit by El Nino, still, if you are a bank that is lending in those counties and you are positively exposed because you lend also in the other counties, then you reduce your lending. Okay, so this is simple. There's no direct demand effect on these counties. This can only be coming from the supply side of banks. So this is our kind of strongest piece of evidence that this is a supply story. Okay? We do lots of different things. Again, I mentioned this placebo on La Niña. We do several different clustering here. And many other things. You can have a look at the paper in case you're interested. So to conclude, we're looking at this final transmission of a climate shock. We think this, and we propose a new novel mechanism looking at the effects of this climate shock through natural amenities and then house prices. One thing that we find that I haven't mentioned, just briefly mentioned at the beginning, banks with lower operating fixed costs seems to be more climate resilient because they're less affected by this physical risk coming from climate shock. And yeah, we can think this could be extended to even developing countries where the effects of El Nino is in fact stronger. And one interesting question would be to see what happens to banks and financial systems in those countries. Thank you very much.
The discussant is Nancy Wallace.
Thank you. So thank you very much for inviting me to discuss this really interesting paper. So the version of the paper I have is a little bit different. It doesn't have house prices in it, but basically all the formulae are the same. So I think my discussion will be on target. So we're looking at how the effects of El Nino as a measure or an instrument for climate shocks are transmitted through the financial system. And this is an empirical paper looking at climate data on the geographic incidence of El Nino effects, on bank lending and balance sheet data at the county and bank level. And we're going to identify the variation as defined by these times when El Nino is particularly intense. And there were basically 5 of these, and this is sort of the workhorse El Nino in all the climate literature. So this isn't an unusual thing to focus on these 5. And so these serious El Nino shocks are treated as quasi-random heterogeneous shocks to temperature. And the identification strategy supports causal evidence for transmission of climate shocks to the supply of bank lending. Okay, so how are we going to measure El Nino? Well, it's a continuous measure, but they're going to make it so that basically we have a set of dummy variables we can use in the regressions that you saw. So we'll have positive county level exposures, and that's where the realization on a given year is a bit lower than the average level of volatility and temperature. And that's, so the northern part of the US is drier. And then negative county level exposure, and again, this is where it's a bit higher, the first is a bit higher, the second is a bit lower, and that's in the South and Gulf Coast. So that's what gives you those two bands. And then these very strong El Nino events, and that's where the average is a threshold of more than 1 degree Celsius. So that's a strong effect. And then they're going to look at various bank exposures. So Filippo didn't go through this quite as clearly, but the banks, basically, we're going to be looking at individual banks that have differential exposures in the upper tier where the treatment effect would be higher, drier, and or zero, which is the middle band, and then the southern band, which is if the branch's county level exposure, the exposures are negative. And then they're going to do various robustness checks where they do a continuous time measure of this. So then there's also the question of the temperature. How are we going to measure temperature? And they're using weather station data. And they're going to aggregate this to the county level. And the weather station data aren't on fixed grids. So there's an issue of the geography that you're measuring because it isn't standardized. And so one comment is thinking about standardizing this using GridMet or some other standardized measure. The data that we're using, I work with people at the Lawrence National Labs. We're using resolution of 4 kilometers. Actually, our papers are on 1.5 kilometers, where the actual grid is homogeneous because using the weather station data, you don't have that fixed grid. So these are just some measurement potential issues. Whoops, sorry, didn't want to go that fast. Oh, now the slowness, okay. And wait, I think I skipped, no, that's correct. Okay, so then we're going to measure at the county level the temperature effect of a treatment by El Nino. And they validate these county level effects matching what we see in El Nino in terms of the signs of the effect. And then they're going to validate county level positive and negative El Nino effects on bank lending. So that's the primary mechanism, and they're using HMDA data. And what was a little hard to figure out is what loans they were looking at. I'm assuming it's 1 to 4 family, but HMDA has both apartment lending and it also has both refi and home equity lines. And so there's a lot of heterogeneity in, quote, what's lending. And then there's also an issue in HMDA about what's a bank, especially over this period because there was a lot of regulatory arbitrage going on. So things that were doing a lot of lending actually were not organized as banks so that they could avoid regulation. And then their finding is that counties with positive El Nino experience a large decline in lending, and it's quite large, and counties with negative El Nino treatments exhibited increased lending. So the mechanism that they can make these statements and these regressions is this exposure mechanism, which is either 1, northern tier, the middle tier, 0, or the lower tier, -1, and then the share of HMDA lending that the bank originates. This is not what's held on the bank balance sheet. This is what it originates in the county to total HMDA origination in the county. And so this creates a measure of bank exposure, lending share, and locates the branches into the county level climate maps. So this is their key variable in running these regressions. And then identification, as Filippo said, is that the time series variation is very hard to predict. I almost showed you a movie. We're waiting for El Nino to come to California. It looks like it's coming, but it's very hard to predict. And then the cross-sectional variation measures the areas that are affected. And that allows them to map this onto the grid or onto the map in this nice 0-1 mechanism where they can do these indices and run these regressions. So the basic idea here is that you have banks where some of their branches are in the treated effect of a positive exposure, some are unexposed, and others are the negative exposure. So that's how we get our bank indicators that aggregate up. Okay, so this is just a bigger version of what I just showed you. And one of the interesting things about the United States is the counties are not the same. They're hugely different between the East Coast and the West Coast. So western counties are the size of some states. So there's a lot of heterogeneity in these counties as you go from east to west. And so again, using census tracts, which you can use in HMDA, will give you a standard grid, so it'll give you a little more control on homogeneity, which you will need for your measuring your treatment effect. Then the other feature is not only are these counties very different in size, but there's systematic heterogeneity in county level, small branch concentration factors. And the exposure is a concentration measure. And so basically my hunch is it's really picking up a lot of very small banks. And I gave you, this is 2002, and this shows you where there's a lot of concentration in small banks. And as you can see, it's very much in the northern tier and the southern tier, conveniently, for measuring El Nino. And then the big banks, and so one bank the biggest bank failure in the US was Washington Mutual, which is Washington State, which is in the northern tier there. The concentration levels of larger banks are very small. And so these big banks and the effect of the big banks are going to give very low ratios. Where you're going to get your power and your regression is from these smaller banks where there's a lot of, where the concentrations are higher. Okay, and then we also have a lot of dominance of the large 19 banks. So I think the mechanism here is primarily through the smaller banks. The larger banks dominate in deposits. They also dominate in mortgage origination. And you can see it in the summary statistics in that they didn't give the means and the medians, but clearly there's a lot of skew in these data. There has to be, given the reality of how lending works in the US. And so again, I think the channel, which is very strong, is really coming from the small banks. And the difference in the location of these small banks and their activity in residential lending over this time period. So I think it would be simpler just to make it small banks, then we can understand the mechanism a little bit more clearly. So of course, a lot of the El Nino climate risk literature focuses on shocks to agricultural production. And obviously these regions specialize in different crops, and these crops are differentially exposed to El Nino. So, as you can see, again, the county is too big a unit measure. I'm just about done. So this is for corn yields, and as you can see, they're very different over El Nino and La Niña in the two things that we care about. This is in the northern tier, and these are a little bit small, but they show the similar things for maize in this upper left hand and wheat, which are hugely affected by El Nino, and basically this is all about crop yield. So these are major agricultural production centers in the United States. And again, this is a mechanism that's driving some of this amenity value. And small banks, in particular, are big agricultural lenders. And so that's what I'm showing you here. In the 1998, the one El Nino event, strong El Nino event in 2016, agricultural loans were upwards of 2%, or sorry, of 12% of the lending for small banks. Sure, real estate loans were big, but nearly a comparable amount, about by a little less than half, were agricultural loans. And obviously the large banks don't do agricultural loans. This is primarily the purview of small banks. Okay, so I just quickly, the major treatment channel here is the 5 El Niños. So we're getting a repeated treatment on the same counties. And so I have some concerns about this repeated treatment structure in an OLS, which is how these things are run. So whether or not this is the average treatment effect is, and whether or not we have some concerns about homogeneity, because I do think there's a lot of heterogeneity without getting these grids controlled a little bit more tightly, and whether or not it happens instantaneously and permanently. And because there are these repeated treatments, I think there's some concern about what could go wrong in these regressions, and that maybe we should think about some kind of staggered diff and diff for this application. I'm sorry I didn't do the lasso. The lasso is really cool. The lasso then looks at like what in all the balance sheet elements is related to this. And what they find is that it's the physical assets, but it's also the share of agricultural loans. So they didn't pick that up, and they had all these elements that they were looking at, and they dropped the agricultural loans, and yet I know they're the most important. So this is a really cool estimator. I really like it, and I think you should put it back in. Sadly, the El Nino doesn't work as well when you don't use this discretization strategy, but I'm not sure that's so important. So this is a really novel and exhaustive study of an important transmission mechanism or possible transmission mechanism, El Niño, to the banking system. They find some strong transmission evidence. There's some fine-tuning, keeping the grids constant and things like that. And it's a very nice application of lasso, and I'm really sorry you didn't have time to present it. Thank you very much.